All right. Yo and hello. Hello, this is Niaz again, back on this fine Tuesday, um, 19th of July, doing a little bit of an update of the market. And also give you a heads up that soon I'm going to be opening up my own website and well, do more long form type of videos and articles and more like let's say like a newsletter type of service. Um, Just to give you a heads up. But it's part of I have some long-term plans as far as making my own funds and everything. But that's for a different time when I actually have it up and running. So basically, I'm just gonna do a little bit of update on the market and kind of look at the market, see how it's behaving, how it's acting, and basically what we're going through right now is quite an important time in terms of like what um, what's transpiring because a lot of things are happening right now and what the thing is that the mood is kind of getting more let's say um, negative, bearish, and personally speaking I'm kind of by nature contrarian, but however, I mean, you gotta think like it's not gonna think, I mean, this is kind of a norm. I mean, if you go by people who've been trading for a long time, big names, Dennis Gartner or obviously everyone's villain George Soros, and he's a villain for a good reason, but he is a good trader. It's that as much as people say that sentiment and they focus on that, many times the sentiment goes all across the board and doesn't mean much, right? So some of the sentiment numbers you will see people are more negative than they were before. However, that doesn't mean they can't be more negative, right? And so I think it's important to understand that sometimes the crowd is right. In fact, many times the crowd is right. The difference is that you have to kind of make the judgment to be contrarian when there are reasons to be contrarian, right? And I think some of the reason I'm saying that is because essentially the market, the way it's moving, a lot of people are kind of I've seen that on the news and everything, CNBC, you know, still having people and calling in like this is kind of like they think this is correction. That's not something bigger than that, which I kind of doubt. Now, true, we've lost quite a bit of real estate on the major markets, major indexes, but and right now though I'm going to show something where the market is in fact basing, and this is something we have talked about before, we've seen that before, but it's basing in a narrow range. It's been basing for some time, and so the question is, will it base some more, or is it gonna flip down again? And that's really the $1 million question. And like I said before, that if it bases for a long time, if it goes sideways for a long time, as a trader, you have to be flexible, because then does our underlying facts, does our underlying basis for our bias, does it change? Are the environment under which you know the conditions that we find ourselves in, which is driving our bias, right? Does that has that changed? Has that environment changed? If it hasn't, then well, it's still the same, right? Our bias, logically should be the same because, well, we're still working under the same kind of conditions. However, if conditions change, then yeah, we are speaking of maybe something is changing, and we got to take action. So that's it. So let's go ahead and take a look at SPX. So first of, we're gonna look at basically the way the market's been behaving, and something that's interesting is that, as I've talked about before, is like this zone that it's been kind of bouncing around for the last month or so, and that's important is because you can see that the range that bounce up and down, and the range is quite big. Intraday, they can range really hard one way or the other. And the weird thing is that they will make it's not a consistent you know s- uh, like a consistent move up or down. It kind of like market kind of bounces, kind of blows up, or just collapses, blink of an eye. Um, I mean, you can see, right there, right? That was Monday, Friday, Thursday, Wednesday. So you can see the way it's moving. It's not like this, right? Even these, like when it moved up, um, there were some of these days. I mean, this is obviously kind of what is that on the 8th? This is kind of a topping kind of a pattern there, um, or price action. It's not a good top price action because it's not like consolidating. I mean, this is a big bars, but for what it's worth, I mean, there's intraday it moves quite hard, but lately it's been moving like basically it just like falls off the bed, or just again like there's like it's on a rocket ship and it's just going up. Um, so that's something interesting to watch intraday. And on the dailies you can see that there's on the SPX that there's this top resistance line that's kind of forming down. And again, this is something that we've seen before, we've talked about before, is that it's really coming and like touching that line. Now the question is this something that we might have a uh, is it gonna go down or go and break this line? So if it does break this line, we have this pivot high over here, because then if it does break it, I'm assuming, well, I guess we can assume, but the 39.20 to 39.25 was an important level before. So if it breaks through that, and if it breaks through this resistance line, then especially with force, we should expect that to also break through this 39.20, because the difference isn't well, it's about 25 point difference, because that's about it. 38.90, and that's about 38. Yeah, that's said 39.26. Um, I mean, you can hold that wick to the top side over here at 39.44 as the ultimate break point to the upside. Um, but most of the price action has been here, really. I mean, it's up to you if you want to, I mean, if you want to be more safe and more technically speaking, that's more the technical right thing to do, is wait for this break. But, this is just conditions that we're looking at price action wise. But why it's interesting is because, again, look at the, you know, um, range. It's very narrow, and the ranges are really moving really fast though intraday. Um, and the other thing is that you have higher lows, but then slightly lower low. Over here, it's you have high, right? But then the next high almost touches it and doesn't go up. But the next high then kind of goes above, or actually still not above this line, this high, which is 39.18. So basically, we're stuck in a sideways market here. How long can it be sideways? The longer it stays on the sideways, the more that it kind of loses its potential, right? Its um, downside momentum, right? And if you start to have news coming in that bounces to the upside, then we have a problem, right? I mean, then we might have to change our bias, and and especially if it kind of breaks up through a important technical point like 41.75 over here. Well, then we're talking about a maybe the bear market is out. Maybe our initial assumption was wrong. I mean, although our assumption has been working pretty well, things happen, right? And as the market changes, you wait around and have the market prove you wrong, and then take the opposite side. So yeah, so basically, technically speaking, it is kind of a sideways market right now. Now, one thing to keep in mind is that also you have kind of like a pennant pattern, or almost like a, yeah. You also have something like a actually yeah. It's kind of a weird pattern because ideally you want this bar to be lower than this bar, like this low to be lower than this low. Technically, for technical like pure, let's say pennant pattern, or this is also like a triangle pattern. You also have this pattern over here, right? Technically speaking, this is, since it's on a bear market, these are kind of a continuation pattern. So in other words, that we should see the market kind of break down. Now, if it becomes so narrow where the market is just like getting narrower and narrower, then there's a chance it might just fake, instead of going downside, it might break up to the upside. However, given that it's a bear market, and generally speaking, these are um, uh, continuation patterns, I think we should expect for it to kind of start to roll down. Also, another thing to understand is that it's a very important point that we're forming here. This is converging with this, you know, um, resistance line. You have a couple of pennant. You can basically, this is a, well, this is not exact, like over here, right? So yeah, I mean, this is not the most like technically, valid, let's say, but what's more important is that you get to understand the market dynamic, the pricing, the price action. Everything doesn't have to be 100% or like a textbook. What's more important is that the prices are getting compressed. You have levels that are being touched from many different like patterns. You definitely have patterns, some, let's say, nice patterns, some not so nice, right? So that's something to keep an eye on. Ideally, you want to wait for the market to break out one or the other to take um, like a swing type trade or a longer term trade, because if it does go to the downside, we're looking at this level to be taken out, then this. So that would be, low end is the lows of 37.21. And this is, if you want to like get to the big low, which is this 36.36. If you do that, then like I said, we're off to the races. Beforehand, when we looked at um, what was like something like 3200, is like really there's a lot of room to run. Come on. Yeah, so yeah, 3200 or so. I mean, there's quite a bit of room to run there. So basically, technically, that's kind of like where we are at right now. Now, why is it stuck in over here? Because there's a lot of basic news flying around, right? Obviously, we have problems with inflation and what the Fed's about to do. Now, there's two things that are fighting here, and that is macro data and earnings. We are going through earnings season, um, and the let's go over the macro data. So the macro data has been pretty much kind of crap, some really bad, especially last week when you saw this kind of a move like to the downside. That was due to, let's bring up our macro data. Crude. There you go. Okay. So basically we had our big data that we have to look for now is basically look at CPI and the inflation indexes, right? You have to also look at something like the PPI numbers and everything that goes into it, right? Because the PPI numbers is the source number. Really, CPI is kind of like a lagging indicator. That's on the lagging end. What goes into CPI is producers purchasing index, right? So generally speaking, there's anywhere between like a couple of months to 3-4 months of a lag time for CPI to be affected by higher producer purchasing number indexes. So that's was something that you have to look at. Now, um, at the same time, you had core PPI that came out, right? Again, PPI came out at 1.1, forecast was 0.9%. For month of June, core PPI came out to be zero point 0.4, forecast was zero point 0.4. So that's something to keep in mind. PPI year to year was 11.3. Expectation was 10.9. That's a pretty big number. Core PPI was though 8.2, 8.3 was expected. So it's all right. Um, Now, continuous job claims, that's the last front that the numbers are kind of holding steady, but they are kind of deteriorating because the essentially again this is lagging, so to speak, because if a company they make job cuts or hiring, that's like the end, like the some of the end result of like business conditions, right? Are they making money or not? If they are making money, they forecast a increase in business. Then increasing business or forecasting of increasing business would cause them to hire more, cut more people, right? So that's basically something that we have to keep in mind. And okay, inflation rate. Oh, so the biggest number that came out was inflation rate. Inflation was supposed to be 8.8 forecast. It actually was 9.1. And so um, where there you go. Initial jobless claims forecast was 238. Actual was 244,000. Slightly higher. Again, not the worst number, right? 244 historically is pretty damn low. Now, though, what's important again to understand is that some of the basic data that we have that's driving all these numbers are kind of bad. Like if inflation is 9.1, that's going to eat into corporate profit. So Fed has to fight them. How do you fight them? Well, jack up the interest rates. The interest rates are being forecasted to be, at like 3.4 or something like that by the end of the year. So let's take a look here. Um, okay, so our initial, yeah, and so basically like um, you have the target probabilities right now standing at 64%, that we're gonna go for 0.75. Um, and right now, at one, whole 1 point at 35%. Oh, hold on, that's 70/50. Yeah, that's about right. Okay, so basically, what's happening is that again, inflation is higher. They have to jack up interest rates to fight that, and that has a problem. The problem is that that will eat into earnings basically, right? So now this is the portion of where the good news, quote unquote, we have to look at it, which is earnings. So let's look at earnings. It really started last week, right? Late last week with all the financials coming out. But one of the funny things is that if you take a look at the financials, for example, Goldman Sachs estimates 6.93, EPS is 7.73, Bank of America 0.774, okay, EPS was 73 cents. Schwab, this is as of like Monday, estimated about 91 cents, came out to be 97 cents. Uh, IBM, that's something to look at, and their future outlook. Again, I haven't actually gone through all of them right now. Again, this is a quick video. By the way, in the future, I'm going to be actually doing more like in-depth videos and in-depth like look into the market, right? And also look at like trading ideas. That's more. This is like my everyday trading kind of I do, right? Right now, since I've had pretty good trades lately, I'm not really trading as much because, well, I don't have to. But I'll be doing like more like longer term kind of a outlook and more like other kind of uh, more let's say uh, ideas that maybe like it's off the beaten track, so to speak. So basically, though, you look at the numbers that came out, those are good numbers. Um, okay, let's see. You have BlackRock. That's a Bank of New York right here. EPS was 1.12. Actual came out to be 1.3. Which was actually bad. So you have BlackRock at 7.636, slightly lower. Come on. Okay. Citigroup is something important to look at because they have exposure to the consumer, and this is something we might have a problem in the future with high inflation. Consumer, I'm gonna kill this platform. Okay, actually, this is one of the best platform, Thinkorswim. So anyway, estimated was 2.9. Estimated was 1.67 and a half cents. Came out to be 2.19 cents. On and on and on. PNC 3.11 and a half. Again, PNC has consumer exposure. 3.42 was the actual. Um, damn it. Wells Fargo was 0.771. Came out to be 0.74. Okay, so you get the picture. The overall is pretty good, right? Or at least better than more or less more often than not they're better than what they're expecting. Um, so TS, that's something to look at. Taiwan Semiconductors, right? And 1.5, 1.5 and a half was that actual earnings. But why are we looking at these numbers? JPM again. JPM is kind of lower. Okay, but that's one bad one, I guess. Okay, so why are we talking about that? Because the thing is, the people who you talking about like CFRA, you're talking about like Moody's, all these other people, right? The people who rate the market and kind of set estimation for like earnings, right? If the earnings is some like estimated like 230, 240 on S&P, um, the problem with that is that's the expectation. How it's kind of hard to kind of think about how they're going to be able to achieve that looking forward, because what the numbers we're seeing is looking backward, and guess what, the Fed has barely started to do tightening. They started tightening on the 1st of June. Like, it's literally just 1 month of tightening data we have here. And even then, they were really tightening the first couple of weeks that hard anyway. Really, I haven't I think the last week is like um, when they kind of started to jack it up a little bit. Um, and also, these are numbers that we're seeing in a better condition, right? If the conditions are worse and they keep on being so, then we again have a problem. That is, um, this is gonna be bad for the earnings of companies, right? Because cost of business goes higher, and that all the capital that's free flowing outside, they get, well, not all the capital, a lot of the capital gets sucked up, and so essentially this has a downward pressure on earnings, and so that's what's supposed to happen, right? And that's what logical to happen. Then we have to ask ourselves, why are the people who rate companies and rate earnings haven't downgraded them yet? The expectation that I have is that they will start doing so. And right now the numbers are good, so market kind of went up, but they will start doing so and plugging that in. We haven't really hit that time frame yet. because what's generally speaking, people start to revise their estimate like after the earnings season, while everyone's done. So we might see something like that. And again, before the this month, like I've said before, that we should expect some kind of a summer kind of a rally. Again, this is not the type of rally I wanted, right? This is not like, because it's still stuck. Now, if this becomes a consolidation area, this rally we might have might be a major rally, right? If it keeps on consolidating like this. However, again, this rally is not like a bear market rally where it kind of goes up, rallies for a couple of weeks, 3 weeks or so. More of an upward action hasn't happened yet. So stuck in this range as we talked before. So why again? The point being that if they revise earnings on aggregate earnings, right? Um, if it does go down and they start to like factor in earnings that are um, let's say like 220, we're gonna see repricing of S&P. Now, if we are, because again, they have barely started to do quantitative tightening, and also, as far as the estimated like rates for the end of the year, we're looking at 3.5 points. That's like almost like double what we have today. So that's what the Fed tool is saying, right? So this is next month. Let's look at right there. So you're seeing that by December, it's 3.5 to like 3.25%, right? So, um, so what does this mean? That means that right now the valuation hasn't caught up to underlying, conditions of the market, right? Also, at the same time, you have the dollar that's still moving on up. Again, another headwind, right? And so this is kind of funny because this also kind of tapers down the foreign earnings of American companies, because these are global companies, right? And essentially, what happens is that if the earnings overseas, like let's say some like local currency, and they convert it to dollar, guess what? Um, they're not going to be able to get as much dollars because those currencies are really weak, because all the countries in, well, not all, but major countries, many countries are going through very hard times, and this will actually give us some trading opportunities. But the point being that they're going to dollar as a flight to quality, as a safe haven play. Problem is, again, this has again a downward pressure on earnings. So what we have to look at is after the earnings season, possibly after the earnings season. So this consolidation that we have in SPX might keep on going on the regular markets in general. We have to basically wait for the revision. If they don't revise them, then you know, uh, let's see what happens. That's like you know, uh, I guess like defying reality. But maybe people believe defying reality, and they will just make believe that, or like just act like the earnings would not be hit. The point being that we are probably like likely to see an earnings bear market here. Okay. Now this also has right now the potential of like the bond market. The bond market early in the year was kind of like weird because they were going, if they were like rebound, if they were going up, the S&P was going up. If they're going down, the S&P was going down. So that's kind of weird, right? Usually they have inverse relationship, but now lately they have hit that kind of a relationship. Um, but that's again a market that you have to look at due to the inversion. Now, however, people really over like exaggerate the uh, inversion, because let me show you something here. Um, so yeah, so basically you can see that you have the 10-year. Uh, okay, two. Now this is has inverted. That is true. Um, but however, this has to stay like this for some time, right? And people like overreact with this. And okay, let's see. There you go. Um, it has to stay like that for some time. And like look over here. Like if you look back in 2005 or 2006, before the actual bear market, it stayed for some time. Below zero. And so that's the two. The reason it's important is because essentially the banks are commercial banks, or the primary bank, sorry, is basically taking money, right? And they're making 10% or the whatever it is on the 10-year, right? Because you're gonna get a higher return, and they're lending out at the 2-year, right? So they're making the difference. They're making the spread. But if the spread is zero, then causes a problem because they're not, that they're not going to be able, they don't, they're not going to be basically funding, right? They're not going to be generating more loans or more credit. So we have a problem, right? Things slow down. But also it's kind of funny because again, people make the mistake is that if you look at the actual bear market when it happened, they actually tend to kind of steepen again. So this is something that people miss is that they invert, but they stay like that, and usually before the actual bear market, they start to kind of steepen again, right? Because then people start to they were fearful at the beginning, but then what happens that the fear kind of gets, like realized, and then they start to, buy into the shorter term, um, uh, the front end of the yield curve. Now, more importantly is to look at the 3 month to 10-year because the 3 month is essentially considered the cash rate. And so the reason it's important is basically this is um, okay. So this is what's liquid, right? In other words, that once it goes from down to like almost the consumer level, this is the kind of like the relationship, the liquid relationship between the 3 month and the 10-year. And so this is actually what I forget the guy who kind of started researched this. Actually, the first guy kind of who like really looked into the credit spread as a trading vehicle or analyzing vehicle. So basically, the whole point being that uh, that we're not really there yet, which is maybe a good thing or a bad thing because clearly the trend is down. But the bad thing is we got more to go. If we get into a bear market, maybe it stops. Again, it's not that bad as you can see right now, right? Uh, it was kind of really bad before the bear market, last bear market, uh, the financial crises. So basically, that is our condition. And let me, where did that go? Yeah, so this is basically a source that's sourcing the information from the Fed. The Fed used to have like this tool, I guess. Yeah, they got so much data. I might have to go back and find where the tool is. However, this is basically kind of the number that we're looking at, right? And you can see that essentially about here, it's flipping to the downside, right? And so on the 18th, there's it is inverted. Um, so let's look at 1980. So 2000. What was that? 2006, right? Let's look at 2006. Okay, see, this is really really bad, right? It looks like much worse than what it is today. So my point is that if, in fact, once you have an inversion, generally speaking, you kind of stay in an inversion. Like if so, we might stay or see this area more and more and more than the inversion area basically. In other words, we might stay inverted or start touching it all, more and more. So the reason I'm showing all that is because another reason to kind of expect the market to keep on heading down, um, because with inflation coming in, higher interest rates, putting downward pressure on earnings. If we have a earnings bear market, like I said before, like if we go to, let's say, 200, even 200, um, on S&P, right? Right now S&P is about like 20 PE, whereas generally it's about 15, right? So if we go down, let's say 200, which is right now we're at S&P earnings is at the 210. So 210 into, you know, um, actually lower than that because we had 38, whatever, 38, 30, right? So it's lower than 20%. Sorry, 20. However, though, if we do, let's say, go to 15 based off of like, 205, um, then we're looking at 3,000. And like I said before, that's like, our expectation. Um, that is to say, if valuation goes to normal, because that's the normal PE valuation for S&P. However, though, if our earnings start to, be lower, or the expectation, with downward pressure on earnings, if we go like 190, 200, I mean, then we're looking even more downside market. Um, so that's basically, again, fundamentally speaking, we're still looking at a down market, or should be a down market. Um, So yeah, I don't want to keep on dragging this out. It's 37 minutes. Man, that's longer, way longer than I thought it would be. It's usually what happens. We look into some of the trading opportunities, next time I start doing this. Let's look at, again, you look at like the way the market goes, these levels are like from way below. I wasn't really again trading, but you can also see these levels, right? The stay, the break, very narrow move, like uh, the base for some time, and this is what's been happening the last week or so, right? And then boom, they go down. Um, yeah. So also, by the way, as the market goes, as the jack up the interest rate, this will also impact margin. I totally forgot. If right now I think the margin on S&P earnings is like something like 11%. So at 11%, if it goes down to, let's say, 9%, right? That's about 2% below, which would be about 20%. So if market goes down 20%, if the margin goes down by 20%, we should probably expect the market to go down 20%, right? So if that happens, then, I mean, that's not necessarily the case. It could go down some other number, but um, then again, we're still looking for some downward movement. So I'll leave it at that. Um, Again, I got other things to do, and make some more videos about some of the other markets I'm looking at. So, all right, guys. I guess that's it for now. Last bit. Let's look at. There's still a lot of info, like markets, data that's gonna be coming out. Um, let's look at this week. Something that was important is the housing market is also, that's something to understand, is that it looks like the housing market is in the early stages of breaking down. You have like housing market indexes that are getting lower. You have more houses that are getting like coming online. You have higher interest rates. There's less, just simply less. There's both on demand side. Demand side, basically there's lower demand or seemingly there's lower demand building up, right? Um, and so we might be seeing again housing be the next breaking next market to go down. And again, if housing goes down, it's they're not as into they're not the market isn't like as, let's say, dependent on the housing market. The risk on assets are not necessarily based off of the housing, as much as they're not as vulnerable to housing market like in 2008. However, though, there's still, the most expensive thing an average person can buy is a house, and if housing prices goes down, that's going to have an effect, right? So again, look, just keep on going lower. Case Shiller was also down. Um, let's see, like mortgage rate. Look at mortgage rates keep on getting higher and higher and higher. Um, right, mortgage rates right there. So went from 3.5% to all the way up to start of the year, all the way up to 6%. Now it's like 5.7, three quarter, right? The average, like people are paying literally, like 50% more for the same house that they did, a year ago. So this doesn't bode well. Again, housing numbers are starting to slip, and again, that happens, um, then you know that should be a really bad thing for the market. So anyway, I don't want to keep on harping on the same things. So I guess I'll leave it for now and talk to you guys later. Watch out for overseas market because they're really linked up with the regular market, because all the overseas market is kind of like headed down. If they're doing pretty well, that would imply that there should be a weaker dollar, and generally speaking, then we should expect our markets to go up too. So that said, I hope you guys learned something from this. This is all like entertainment, let's say, educational. Look at that Somalia. Um, yeah, I mean educational or informational. None of this is our advice. Like this is all a market fanatic or market fan of the markets, uh, trader, institutional trader, now retail trader trading my own account. So my take on things. So again, not advice, but good luck, and see you guys later.